What's up, everybody? Joe Brown here with Heresy Financial, and we are seeing the lowest consumer sentiment numbers we have seen since 2011. The March numbers just came in, and it is not looking pretty. On top of that, we are also seeing the highest inflation expectations since 1981. Those two things together are not a good combination. So we're going to talk about what that means and why the Federal Reserve's attempts to fix the problem might actually make things worse. Ready? Let's dive in. Today's sponsor is WESA Health, an opportunity to invest in a company in the early stages of cutting-edge medical science, but more on that later. Okay, take a look at this chart from Bloomberg here. You can see that the top section is going to be the sentiment index. It has not been as low as it is right now since 2011, and that was just a brief dip down. Now, if we take a look at the bottom section of the chart, this is the inflation expectations for 1 year from now. And for just about 2 years, the inflation expectations have done nothing but move up. They've just ticked higher and higher and higher to the point where now the future inflation expectations, the expectations for what inflation will be 1 year from now, is the highest that it's been since 1981. And for those of you keeping track, that's over 40 years. Now, some of you may have noticed something about the consumer sentiment reading and how it's the lowest that it's been since 2011. Take another look at the chart here. You can see that was the bottom. It basically moved up from there. And if you think back to living through 2008, 2009, 2010, 2011, and going forward, that was basically the bottom when it was a perfect time to start buying real estate, perfect time to start buying stocks. Things started to move up from there. That was a great time to be a contrarian and to go against what the sentiment was. So the thinking right now is maybe, are we at the same place? Are we just in this place right now where we can't see into the future? And in hindsight, we're going to look back and say, that was the perfect time to buy. Well, maybe, but maybe not. Because if you look at the things that are driving consumer sentiment right now, number one, it's inflation. And in this sentiment report, the highest number of Americans ever are reporting fears about their financial conditions getting worse over the next year, primarily due to not being able to afford basic cost of living, seeing their prices of the things that they need to be able to live go through the roof. And again, you might be asking, well, why does that mean that it can't get fixed? Why does that mean that that problem will persist or that things will get worse? Because the things that people are buying right now that are driving inflation higher are the necessities. The biggest components of the latest inflation reading and for months have been food and energy. These are not things with elastic demand. If the prices of food and energy continue to go up, people will continue to buy these things. It's not as if people are going to say, you know what? Groceries are just getting too expensive. I'm not going to buy groceries this month. Of course not. Maybe they'll buy different groceries, but you still gotta eat. You still gotta buy food. Same thing with energy. Look at gas prices, look at cooling and heating. People are going to need to do these things. They're not elastic demand. People just have to buy them. Maybe you can't buy the other stuff as much, but you're going to prioritize those things. And those are the things right now that are driving inflation highest the most. On top of that, wage growth has not kept up with inflation, which is adding on to consumer sentiment saying, hey, it's taken so long for wages to respond that prices are going up at a faster rate. We're actually taking pay cuts. This is not something that resolves itself quickly. In response to the rising inflation, the Federal Reserve is being forced to work on it and do something to at least look like they're trying to fight the rising prices. It is, in fact, one of their mandates by Congress to maintain stable prices. And so they already stopped adding assets to their balance sheet on net. You're going to see their balance sheet kind of move sideways, up and down a little bit, but mostly just sideways. They might start selling assets to combat inflation. That's called quantitative tightening. That's selling assets That takes dollars out of circulation, just like buying assets put new dollars into circulation. The other thing that they are going to do is start to raise rates. Now, number one, this is probably not going to have much of an effect on inflation. Too little, too late. However, here's the biggest problem. Even if it does at some point have some impact on inflation, we have to look at how monetary policy works its way throughout the economy. This is called the Cantillon effect, and it's where monetary policy first hits asset prices. After it hits asset prices, then it hits the prices of goods and services, then it hits wages. And so we spent a year where basically we didn't have a lot of inflation from monetary policy in goods and services. We had inflation in some of those things from the supply chain disruptions, but not from the expansion of the money supply. But essentially, most of the monetary policy during 2020 hit asset prices. So we saw an explosion in the stock market, an explosion in real estate prices. That is what you would expect given the Cantillon effect. Monetary policy hits asset prices first. After that, it starts to work its way throughout the economy and hits goods and services. And so we've seen massive inflation in goods and services since then, which means if monetary policy gets tighter and they start to combat inflation, what's going to get hit first? It's not food that's going to come down first. It's not gas prices that are going to come down first. It's asset prices. So do you think that U.S. citizens, Americans, are going to feel more confident about their financial security, about their future, when asset prices start to tumble, while food prices, gas prices, housing prices, clothing prices, car prices are still going up? Absolutely not. That's one of the worst case scenarios. But that's how monetary policy works its way throughout the economy. That it'll take at least a year for that to work its way through and finally start to hit the prices of goods and services if they combat it enough, if they're tightening enough. And that's the question. They might not do it enough simply because of the pain of the asset prices falling and tumbling as a result of their initial fight against inflation, their initial tightening. So it is yet to be determined how far they will actually go. But no matter how far they go, you are going to see it impact asset prices first, further declines in asset prices like stocks, and potentially hitting real estate as well, though real estate moves a lot slower than stocks, hitting the bond markets, fixed income, and it'll hit those kind of things first before it ever touches goods and services and has an impact on inflation. And now I'd like to tell you about today's sponsor, WESA Health, and an opportunity to invest in a company that is in the early stages of cutting-edge medical science. Before I do, I'd like to tell you a story to kind of frame what this company does and where they're coming from. I recently read a book called The Spirit Molecule. This book is about DMT by Dr. Rick Strassman, who did the experiments back in the 90s with DMT and volunteers. Now, DMT, if you're not aware, is one of the most powerful psychedelics there is. He details the accounts of 60 volunteers who took DMT and had absolutely wild experiences, and he also details the therapeutic potential of psychedelics. Now, the other thing that you'll notice if you read this book is that the regulatory environment made it almost impossible for him to be able to conduct these experiments. Just the sheer bureaucracy and the amount of red tape for something like DMT, which you can access through completely legal things like plants, but in order to get it for an experimental setting, had to go through all this red tape to the point where it made it almost impossible. Well, the tide is now changing, and the regulatory environment is now shifting to one that is becoming more and more easy for companies to start experimenting with the therapeutic nature, especially for mental illnesses and brain injuries, with psychedelics. Now, we all saw over the past 5 to 10 years what a regulatory change and environment did for an industry like cannabis. Medicinal regulatory changes brought a lot of money and made a lot of wealth for certain companies. WESA is kind of on the cutting edge of new scientific medical research with psychedelics and using a therapeutic approach with psilocybin and other compounds. And if the regulatory environment continues to go in their favor and the experiments that they're running that are legal and approved by the FDA continue to show good results, they could be one of the forerunners on this new frontier of a therapeutic approach. So where did WESA Health come from? Well, the founder, Daniel Carcillo, was a professional hockey player in the NHL for 9 seasons. He played with the Chicago Blackhawks. But the problem with playing hockey at that level for that long is you get hit in the head a lot. And he was forced to retire from how many concussions he had had, and it started to impact his health. He was slurring his speech, he couldn't focus, he had problems looking at bright lights. It really impacted the health of his brain. And after years of trying all the traditional routes and not having any success with finding any improvement, he decided to go the non-traditional route and found psilocybin through mushrooms. Now, I know for anybody not keeping up with the medicinal science, that sounds like it might be a little bit out there, but these compounds are combined with evidence-based therapies and other plant medicines and adaptogens to make sure that, number one, the procedure is going according to a plan, but number two, the exact chemical compounds are getting where they need to be, and they're not introducing anything, they're not hallucinogenic, anything like that. This is medicine. And after just 6 months of these non-traditional procedures, he found that his brain scans no longer showed any abnormalities. His blood work had normalized. He was able to speak and act a lot more normal. His mood was more regulated, and he was able to connect with his children even more. Because of this, he has kept his large ownership stake in the company through the development and still owns just about 22% of the company just himself. But it's not just him. WESA Health has a large team of industry-leading researchers and a growing network of clinics and psychiatrists who are pioneering this drug development and clinical therapy. Now, what WESA Health is doing is a little bit unique because not only are they pioneering the research on the combination of proven chemicals and compounds like psilocybin mixed with CBD to specifically target areas of the brain, but they're also pioneering the clinical practices, the therapy, the procedures on how to administer it for the best results. And with that part, they are actively opening up new clinics, which cash flow for the company that provides the resources they need to continue the research on the compounds. There are some extremely large markets that WESA could be targeting in the future, like for instance, depression could potentially be a $14.7 billion global market by the year 2025. And with a growing number of people all around the world encountering anxiety, depression, mental illnesses, and also experiencing brain injuries and having no relief through the traditional medicine and traditional care, it is becoming more and more of a need, and regulators are becoming more and more favorable toward alternative approaches and researching to see, should we allow this and are there potential benefits? And the answer seems to be, from the current studies that are going on, a resounding yes, which has brought the attention of large investors like even somebody like Mike Tyson, who is invested in the company. Between institutions, large investors, and insiders, they collectively own over 40% of the company, which means that they believe the potential for future results are massive. And considering everything we've looked at, that very well may be the case. As always, this is not an investment recommendation. This is not financial advice, and I do not own any shares of this company. I am not a shareholder and have no ownership. As always, I really appreciate you guys. Thank you so much for watching. Have a great day.